Segmented income statements are used by managers to make decisions. Managers are going to need more than just the company-wide income statement. They're going to need income statements that focus on the various parts of the company. So Target Corporation might want to have an income statement for Target Corporation, but also one for the College Station store. Or they might even want to drill down further and look at the clothing department in the College Station store. So a segment is any part of the organization that managers want cost and revenue data on. Examples could be a product line. Adidas makes various shoes. They might want to look at the profitability of the basketball shoe line. A department could be the cosmetics department at Macy's. Again, it could be anything that managers want this information collected on. It is worth noting that GAAP does require some segmented information to be in the annual report for publicly traded companies. However, we're going to look at the management use of these segmented income statements. So to do this, these statements can be prepared at various levels within the organization. Sales and variable costs are generally traceable to the segment, and it's really fixed costs that are our problem. In other words, we can easily identify the sales of Target Corporation, but we can also easily identify the sales that come from the College Station store and the cost of goods sold and other variable expenses of running the College Station store. But some of the fixed expenses are not directly traceable to the College Station store, like the president's salary. So we need to revisit direct and common fixed costs. Remember that this is looked at from the perspective of a particular segment. Direct fixed costs exist because the segment exists. That is, they're traceable to the segment. An example might be the production department manager's salary to the production department. Common fixed costs exist because of multiple departments. These costs are allocated. Maybe the president's salary is divided equally among all of the divisions. But these allocations are really not very useful when you're evaluating the profitability of those segments. An example would be the vice president of production salary to one of 4 production departments. So this manager oversees all 4 departments, and even if you divided that salary by 4, it is not going to be very useful for evaluating the segment. Now, if you think about why, what would happen if we went down to 3 production departments? Would the manager's total salary decrease by 1/4? And the answer, of course, is no. What would happen is that manager's salary would now be divided 3 ways instead of 4. Okay, so that is the problem with allocation of these fixed costs. Companies often make mistakes in believing that the way they've divided up the cost is useful. And so what we need to do is look at a new income statement format. And you may be thinking, another new income statement format? Well, it's true, but if you take a look, you can see that it's really very much like the contribution margin income statement. You'll start with sales, less variable costs to get contribution margin. Fixed costs will be divided up between direct and common. So first you'll subtract the direct fixed costs to get segment margin. Then you allocate the common fixed costs and subtract those out, and you have division income. Now this segment margin, this is the most useful item for evaluating segments. So this is a new term that you will need to understand. But if you look at this, it's really sales minus direct costs, whether they're variable or fixed. Let's look at an example of segmented income statements. Now what I've given you is two segmented income statements that I prepared for Mary's Market. And I prepared those based on this information. Mary's Market generated total sales of $1,500,000 and operates two main segments. The meat department, whose sales were $900,000 and variable costs were $460,000, and the produce department, whose sales were $600,000 and variable costs were $350,000. The company expects to incur a total of $640,000 in fixed costs. Of this amount, $230,000 is traceable to the meat department and $170,000 is traceable to the produce department. So another word for traceable to meat department, that $230,000 is a direct fixed cost. The two segmented income statements below show the following. The segmented income statement for the two main segments of Mary's Market, meat department and produce department. And then second, a further segmenting of the produce department into two main product lines, fresh produce and packaged produce. Of the $600,000 of sales related to produce, fresh produce generated sales of $400,000 and packaged produce generated sales of $200,000. Variable cost incurred totaled $200,000 for fresh produce and $150,000 for packaged produce. Traceable fixed costs were $40,000 and $60,000 respectively. So if you look below, you see that I have created two segmented income statements, the first one being the two main segments, meat and produce. And then I took the produce department, who had sales of $600,000, and I further segmented that into two product lines, fresh produce and packaged produce. So think in terms of fresh produce is where you pick the apples that you would like to buy individually, whereas packaged produce, you pick up a bag of apples and you get what you get. All right, with that, let's look at each of these individually. Now, it is important that you, with this much information, that you sort of identify what is relevant to each of those income statements. And you'll note that the first part of the information relates to the initial segmenting into meat and produce, and the latter part relates to the further segmenting of the produce department. Let's look at each of these in turn. All right, so here we have the first segmenting, and you can see that I've highlighted the sales in yellow, the variable cost in green, and the traceable fixed cost in an aqua blue. All of these amounts are given. So all I did with that information is found the totals and determined the contribution margin and the segment margin. All of that information is given or just computed within the income statement. But then we have to find the common fixed costs. And that $240,000 of total common fixed cost was computed based on the fact that we were told total fixed costs will be $640,000. And we know that $400,000 was direct fixed cost. So $240,000 must be the total common fixed cost. Now, we do need to allocate that among the segments in order to get net operating income. And here we see that for this segmenting, this allocation is based on sales dollars. And if you look at the mix of sales, we have 1.5 million of total sales, with meat being 900,000 of that. That's 60% of sales. So that means that 60% of 240,000 will be allocated to the meat department. Likewise, 40% will be allocated to the produce department because $600,000 divided by $1.5 million says that produce comprises 40% of sales. Now, looking at this segmented income statement, you can see that the company does have earnings of $50,000, but the reason they may be concerned about the produce department is that it is showing a loss of $16,000. Notice, though, that produce is covering its own costs. It is covering all of its variable expenses and its direct fixed costs, and showing a positive segment margin of $80,000. It just cannot cover all of the common costs that is allocated to it. So let's look further at produce and break it into its two main segments. Once again, I've color-coded the sales that were given, the variable costs that were given, and the direct fixed costs that were given in the initial information. Now we can see that the packaged produce is really the problem here because it is not even covering its own direct costs. But let's go ahead and look at how the other calculations were made. The 70,000 is divided equally among the segments. Now I computed the 70,000 because that is, if you take the 170,000 of total fixed cost for the produce department that was direct to that department, and 100,000 is traceable to the two segments, that leaves 70,000 that is common to the two segments. Then it says that they allocated those equally among the segments. So once again, it does appear that the packaged product line is really the problem in our produce department. So what we could do is further segment this into packaged apples, packaged oranges, packaged potatoes, packaged onions. We could figure out which one of them is really causing a problem, or how several of them may be. All right, now you'll get some practice with actually making calculations with one segmented income statement. In the interest of time, you will not actually be doing the segmenting and then the further segmenting and further segmenting. But it is important to realize that this is how you can drill down and identify what is working well, what changes need to be made, etc.